So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again from OptionAlpha.com, and welcome back to The Daily Call. Today we are going to be talking about the basics of a reverse stock split. Yes, a reverse stock split, which is a little bit different than a traditional stock split. And it's important that you understand the difference between them, and more importantly, how they generally will affect options if you are trading options in a company or an ETF, because ETFs can go through reverse stock splits as well, what the impact is on options. So first of all, on the basics, why do companies do a reverse stock split? What is a reverse stock split? The basic premise of a reverse stock split is that the company or the owner of the ETF wants to reduce the number of outstanding shares or float that they have. So they might do a reverse stock split by dividing the current shares by a number such as 5 or 10 or 4 or whatever they want to do. And in that case, it would be generally called a 1-for-5 or 1-for-10 split, respective of how they want to split up the company. So for example, if a company, let's say, is trading at 20 cents a share and they've got 200 million shares outstanding, if they do a 1-for-10 reverse split, it would basically cut the number of shares from 200 million down to 20 million. And then effectively the price would go up by a factor of 10. So the price actually increases by a factor of 10 to $2. Now, of course, in this case, it's really just, smoke and mirrors kind of game, right? Like most companies that do this, either their stock price is falling really, really fast and they don't want to have any influence on this low stock price. So they do a reverse split to get the price back up. Now, effectively, the company is not changed in their market capitalization and how much they're worth, right? It's the same company. It's just how the shares are divided up. So if you even think about Berkshire Hathaway and Warren Buffett's company, they've never split the stock, right? So there's not a lot of float. There's not a lot of shares. That's why the share price is so high for Berkshire. But some other companies, if they get towards that penny stock range, and in some cases they have to meet minimum bid requirements to be on the NYSE or the NASDAQ, they'll do a reverse split to get their price back up. Again, it doesn't change the company. The company maybe still is not doing well or declining, and really the stock price is taking a hit, but it looks like to investors it's more valuable, right? So that's why you can't always, I guess in this case, judge a book by its cover. The stock price is really meaningless unless you look at how much float and how many shares are outstanding for that company and really what the total market capitalization is. Now, in the case of stocks, ETFs can go through reverse splits as well. The one that's more commonly going to have this happen is VXX. VXX has gone through a reverse stock split many times before in the past. And the reason it does is because it is always dragged lower by this negative drag in just its pricing. So it's going to continue to go through reverse splits time and time again. And in most cases, it does like a 1-4 or 1-5 reverse split. And when that happens, if you're holding options, what's interesting about VXX and some of the other ones that have reverse split is that the option contracts themselves don't necessarily reverse split. What most of the exchanges will do, and more importantly, the OCC wants to do, is they want to keep those option contracts kind of on a pre-split new contract, air fingers quotes, new contract, so that there's no extra clearing requirements that the exchanges have to deal with. So in the case of VXX, let's say they do a 1-for-4 split. Well, if one option contract used to control 100 shares, now one option contract would only control 25 shares. So what they would do is they would basically have these new contract symbols traded. And I think what they actually did back in August of 2017 is they had a new symbol called VXX2. And that new symbol was set to 25% of the VXX price. And again, so it leaves option traders without some, lingering half contracts or quarter contracts if you didn't have an even number of contracts that got split. And it really kind of makes it super simple for the clearinghouses. So again, the whole idea though is just to understand how option reverse stock splits happen. Again, that they can happen on ETFs, they can affect option pricing. There's usually a lot of memos that go out before a reverse stock split actually happens. So if you are trading something and you see a huge jump in price, don't be totally alarmed by it. It could be a reverse stock split. Everything is basically the same. It's just a new price. So it might be a little confusing at first, but I think you'll be able to navigate it pretty quickly. So as always, hopefully this helps out. Until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.